Hi guys, Russell here. We had an investor day yesterday, and so this is the slides I use, and I'm going to just give brief explanation. It'll be much shorter than what I did yesterday, where I spoke for a bit over an hour. This I'm going to try and do in 10 minutes. So if you've got any questions, just drop them in the comments, and I'll try and answer them. So we've been running Brumby Capital for about a year, and then for a couple of years before that, we had like a sort of PA portfolio that I published on Substack. And essentially, performance while it was in the PA portfolio was flat, if anything. I think because the ideas I thought might happen weren't really happening. When I saw them starting to take or starting to give in the markets, is when I launched Brumby Capital. And I still run it in the same sort of way, a short book to hedge out what I think are the big unpriced risks in the market, and then a long book on top of it. So you get a gross of 100 and a bit with a net around zero. And that's still the same sort of way I manage things, even though the ideas underlining the risks are different. Broadly, I asked people who come into the presentation to send me some questions, and they broadly came into sort of three categories. I would say existential, like basically, do your theories still make sense? Do we need hedge funds? Why are currencies not the same way? And does the war in Iran change everything? Then we look at some of the trades that the fund has on, and some that we don't. And then some more sort of fundamental questions about Brumby Capital, like what's the investment style, key man risk, and the timeline for, I think, all these things playing out. Okay. So the first one is like the pro-labor theory, does it still hold water? And so what I'm saying is governments are now very active to sort of get to try and transfer as much wealth back to labor. So in the sort of 1980s to 2016 type period, which I'd say is pro-capital, we saw much higher trend unemployment, which created much lower trend inflation. And now we have lower trend unemployment and higher trend inflation. And that's sort of what this graph is trying to say, these two graphs are trying to say. And so for me, in a pro-labor era, what we should expect to see is that central banks have to work much harder to generate the lower inflation that they target. And so if we go back to the 60s and 70s, the Fed fund rate was often above the 10-year Treasury yield, right? So I'm going to use that as being restrictive policy. You can see I've circled it there. The blue line was often above where the 10-year Treasury yield was. And what I find interesting is, like, since 22, 23, we've been in the same type of environment. And if you listen to sort of macro investors, they would say we definitely have a recession, because that's what used to happen in the 80s whenever Fed fund rate got to where the 10-year Treasury yield, the yield curve inverted. And it didn't really happen this time, which makes it much more like the 60s and 70s. And so for me, the risk here is the Fed actually is forced to raise rates above where they are to get inflation down. And I think there are already signs of that they, in my view, the Fed should have raised rates ages ago. It's the same with almost all the central banks, but it's taking its time to come through. So if I take the UK is a classic example of what I would say is pro-labor should be anti-capital. So real house prices, particularly in London, have been flat in nominal terms and down massively in real terms. Asset markets like equities tend to struggle to move anywhere because interest rates are restrictive and taxes are being put on. And the government's trying to pay down debt, so a restrictive policy of sorts. But nominal debt to GDP should fall because GDP is going up, and tax collection tends to be easier from wage earners than it is from capital owners. However, what we've seen in the US is this very unusual circumstance where nominal growth is fantastic, and yet no reduction in debt to GDP, which basically means that every extra dollar of revenue the US government gets, it spends, or either through tax cuts or spending of some sort. It's a truly extraordinary phenomenon. It's not something we've ever seen before, to see a government spend money, even more money that comes in all the time. And so we're in a sort of like a pro-labor, pro-capital era at the moment, where bondholders are the ones suffering. But I would expect at some point when push comes to shove, it's the corporates that get the problems rather than the workers, because they're the ones that have the votes. So in essence, in the US, you have a policy of spending and no taxation. And I launched Brumby Capital because we started to see the gold versus treasuries break out, the GLD TLT, and that for me implied this world that I saw was sort of coming into reality, if that makes sense. Now, what I find really unusual and why, this year and last year have been tricky in a way is that so every morning I wake up, I look at the 30-year JGB yield, which is definitely an inflation measure, and it's gone up, it's up near 4% now. And then you look at corporate debt yields in the States, and they're super low, not as low as they were in 2021 or 2020, but very low, and they've been falling over the last 2 years, so very supportive of equity markets. And what we have seen is what we used to see was JBGB yields just kept falling, which I think was very supportive for corporate debt and US Treasury debt and that sort of stuff. But since sort of 2020, we've seen this a big change in the way JGBs and corporate debt behave. So typically JGBs rally when corporate debt's doing poorly in the sort of pro-capital era. But since 2020, we've seen JGBs sell off, yields rise, and then corporate debt has followed, and those are the circled bits. And what's unusual is it hasn't really happened yet this time. What's weird, I think this is like listed corporate debt to a degree or normal corporate debt, but private equity, private credits definitely see yields blow out, which is sort of in line with what I was expecting to happen. What I didn't expect to happen was US equities do so well in this sort of rising yield environment. That's been a bit of a surprise. But then corporate yields have been falling, so what I find, I look at HYG on Bloomberg. So typically with the short book, what I've learned is when you capture out beta in the short book, you should cover. And beta, as I define it, is like seeing a fall in HYG. So like we saw in 2008 or 2015, in 2020, and again in 2022, when you get that downward move in HYG, that's probably when you want to be looking to cover your shorts, because you're just collecting alpha from them, or beta. And so what's weird is we haven't really had a downward move yet, even with the crisis in Iran. It's been relatively strong, but it seems to be coming to trend line. So I think we're coming to a decisive point in the markets one way or another. And then I look at gold outperforming S&P. So if this pro-labor theory is bad for assets, and I think it should be, it should crowd out corporate debt anyway, then now is the time for short selling, and now is the time for Brumby Capital. So this is sort of answering the existential question of do you need hedge funds and what's Brumby Capital about? This is what I'm seeing. It sort of all makes sense to me. There is an alternative theory, which I'm now going to talk about. The other one is that just, the government, US government is just going to keep abusing its reserve status. And so really all you want to do is be long S&P and short TLT, which since 2016 has been a fantastic trade. So the graph here is S&P divided by total treasury return. And if you're the first sort of from 1970 through to sort of 2010, 2015, what you had is if equities went too far, bonds would go the other way. That's where the sort of balanced portfolio of equities bonds came from. And really from 2016, just been want to be long equity and short bonds. And you can see that's broken out and well past highs we saw in the dot-com bubble, for example. And that could keep working, right? That could keep working. If we look at that specific trade of long SPX, short TLT, you can see from lows in 2020, it's been phenomenal, right? As the government has just poured money into the US economy. Now, what I found interesting, and when I started to launch Brumby, is you've seen in 2015 and in 2025 and 2026, the market has occasionally challenged the trend lines on this trade, sort of saying, hey, maybe things are starting to break up. And again, with the war in Iran, it briefly went through it and it's come straight back up again. So, if you said to me, Russell, I think I'll just go long S&P, short TLT, that is a perfectly coherent, logical answer. I have no problems with that. I just feel like the relative bond yields of JGBs versus treasuries and corporate bonds look wrong to me. And that for me is where the risk is, if that makes sense. But if this is your strategy, that also at the moment looks logically consistent and market is supportive of it. So if this one's true, you don't need hedge funds. If my version is true, you need hedge funds. And that's what I'm thinking and seeing. So, I try and monetize market inefficiencies. For me, if in the view of what I've got of a sort of pro-labor era is I eventually see yields going up and gold going higher. And that will be sort of then force political change through. We're yet to see that. Yet to see any change in politics. So look in the UK, reform looks like it's going to come in. The Democrats in the States are now talking about tax cuts themselves. Everything still points to this sort of lack of financial discipline at the government level. And that will continue until the bond market forces changed behavior. A lot of people ask me about currencies and want me to do more currency notes. I'm a bit reluctant to because it just doesn't seem to be any money in them. What we see, or what I see, is that old relationships with currencies just don't really hold like they used to. My guess is that back in the day, the US used to force free movement, the free trading of currencies, which allowed currencies to move to economic factors. That doesn't seem to be like that anymore. Now I'd say currency, like equity markets in a way, are driven by politics. You need to look at the politics, right? And the only currency I really like is the Swiss franc because the politics there is of currency strength. Does the war in Iran change everything? I've talked about this before, but I think it does for the Middle East and Russia insofar as the energy weapon now looks broken, having now been used twice, once with Russia and now with Iran. And so now all the contingencies to sort of make energy a weapon are being broken apart. And the markets, I think, recognize that was why the S&P has been so strong, looking through that, which makes a lot of sense to me. Now I'll talk about specific trades. You've got GLD, TLT here. So when I first put it on, everyone was very, very long TLT and very, very bearish GLD, which was really nice. That people are not as bearish as they used to be on gold, but the shares outstanding on GLD are still relatively stable from like 10, 15 years ago. And the shares outstanding on TLT are still well up on where they were in 2021. So it feels like that's okay. And also we're seeing short interest come down with TLT as the shares outstanding have fallen. So it doesn't feel like this trade is done yet. I think there's more left to go. On the rest of the world versus the US, so I assumed increased spending by Europe and Japan. And I foresaw capital moving back to Japan and Europe from the US. So I sort of I think Japan and Europe should outperform the US, and they have been to a degree over the last couple of years. And that still seems to hold water just about. So I get asked about oil and Asia. So back, particularly when I was managing emerging market money, Asian currencies and commodity markets were sort of linked together. So if you look at that blue line, when Asian currencies were going up, which is weakening, commodity markets used to be quite weak. It makes a lot of sense. You think Asia is the main consumer of most commodities. And conversely, when Asian currencies were strong, commodities were strong. And that relationship was pretty solid until recently when the relationship between Asian currencies and commodities seems to have broken down completely. And so these days I find no meaningful information in the movement of Asian currencies. And this is why I don't talk about them so much. Now just about me, Brumby Capital. The way I invest has changed over time. When I first started out as a young fund manager, very bullish, concentrated longs. And then the mid part of my career, I realized that currencies were mispriced by markets, which made them very risky. And so I used to build out a big portfolio of short positions of companies that had currency risk. And what I found was shorting companies with currency risk, so they earned revenue in emerging markets but had dollar debt or dollar capex, you could actually generate this sort of currency return in a much more efficient way than actually showing the currencies directly. It was cheaper, you could hold the position for longer, less roller, and the profits were in a hard currency. And so in the mid part of my career, I used to have lots of shorts, but I was actually taking very views on specific currencies, if that makes sense. These days, my views on asset markets is that the nominal growth is good for asset markets, but then the higher yields is actually a negative and they almost counteract each other. So you end up with markets that don't really go anywhere, like in the UK, but you do get volatility. So assets should not be doing that great. And so what I try and do is have a concentrated long and short portfolio of winners and losers with rising cost of capital. And that's, for me, much fewer. Some people ask about keyman risk. I have a standing agreement with Tavira to liquidate all positions if I'm incapacitated. And that's the main keyman risk that we have there. And this is a disclaimer, please read it. And that's really the end of the presentation. Thank you for listening. I hope that makes sense. Got any questions, drop me a line. All right, stay safe. Talk to you soon. Ciao.